Let's connect with Nilesh Shah, Managing Director of Kotak AMC. Nilesh bhai, always a pleasure to have you on ET Now. Thank you for joining us. There seems to be some numbness in the market. FI selling has intensified, VIX has gone up, the market breadth seems to be more negative than positive. Is this that typical pre-election nervousness which has hit the market now?
Well, Nikunj bhai, I think there is more aggressive selling than buying. Buyers are waiting for sellers to sell at a lower prices rather than bid at higher prices. Now, why is this behavior emerging? One could be, as you correctly mentioned, election-related uncertainty. Second could also be some developments on global market side. One, geopolitically, there is tension boiling in Middle East as well as in Eastern Europe. US Fed has also deferred their interest rate cut. And on top of it, the results seasons which has come for fourth quarter, that's broadly in line with the expectation. Our markets were not cheap. So it's quite natural that there will be some amount of profit booking.
So what does one do now? Given that valuations are above historical averages, there is tension in the Middle East. Election is such an could really be a 5-7% swing event. Is one better off coming after the election verdict or even after the budget?
Nikunj bhai, there are multiple ways in which things can be approached. If you are a risk-averse investor, which means during COVID period of March, April, May 2020, you were not a net buyer in equity market, then yes, you should come after the event. But if you are a risk taker, you know what volatility means. You did bottom fishing during COVID period of March, April, May 2020. Then certainly you can take a position in sectors and during the correction. There are three sectors where I believe there could be opportunity. They are right now trading below their historical averages. One is consumer FMCG. While the results of FMCG company this quarter are nothing to talk about, all of them have given guidance that they are seeing revival in rural economy. Maybe it's election-related spending, maybe it is something else, but all of them are confirming that there is revival in rural consumption. We are expecting an average monsoon that should also support agriculture and rural economy, which can take this recovery forward. FMCG companies have been derated in last 12 to 18 months, and hence they could provide an opportunity. The second one will be private sector banks. They have been derated significantly. The deposit and credit growth is still in low double digit. NIMs are coming down, but they have fallen far less than the valuations demanded. So there could be opportunity in private sector banks to accumulate. And finally, the IT sector. Like FMCG, there's nothing much to talk about IT sector's result. Unlike FMCG, they haven't even given positive guidance. But there are 2-3 developments to watch out for. One, after retrenching or not replacing people during FY24, they have given appointment letters to engineering students in colleges. If those students do join on the campus, then we know volume growth is coming. The second thing could be bunching up of sales cycle. What we hear from IT companies is that sales cycles from RFP to order has elongated from 6 months to 18 months. Now, could there be bunching up of orders? And that could result into volume growth. The third development is shift of orders from troubled companies like Atos and Telenos to Indian IT companies. I believe there will be some signals available over next 3-6 months, which might indicate that there is upturn in IT coming from a volume point of view. So I will say, instead of chasing momentum, let's focus on quality and good valuation. And there will be opportunities in sectors like IT, like private banks, like FMCG.
Right. Nilesh, and that's perhaps the only bottom-up story left in the market, right? So you're saying go contra.
Aisha, I'm not saying go contra. I'm saying follow the fundamentals. price is what we pay, value is what we get, as per Warren Buffett. Now, one can pay very, very high price and valuation in some of the momentum stocks, which have extremely low floating stock. There are micro caps trading at twice, thrice the valuation of large caps. Now, some of them may deliver earnings growth, which market is expecting, but experience does suggest that majority of them are not going to deliver. Why take risk on a momentum on a higher valuation? Why not bet on fundamentals with quality companies with some factors which are now turning around?
Sure, makes sense. Nilesh, I get your point about FMCG. I think, the data is out there and the commentary from the managements, which makes you believe that growth will come back to the sector and surprisingly this time around will be led by the rural growth. But why private banks? Because, they may be quality companies, but do you really see momentum coming back into these names?
As a momentum may not come immediately, but let's look at, is deposit growth a worry? Answer is no. RBI has been managing liquidity fantastically, and slowly and steadily deposit growth, while it is coming down, it is still in double digit. On credit growth, corporate India, capex should pick up post-election. Retail loans are slowing down a little bit thanks to the risk weightage increases on a proactive basis. But overall, deposit and credit growth will still be in double digit. Is there any worry on NPS side? Answer is no. Our banking system is more healthy than ever in the past. Now, NIMs are coming from historically high levels to little lower levels, but valuation corrections are significant. We have rarely seen private banks trading at this kind of valuation. There's almost a grouping of all the banks in just one cluster. I think there will be breakout over there over a period of time. And do remember, we are not talking at multi-baggers here. We are just talking at compounding. I don't think so market is going to see kind of return we have seen since March 2020 till now. In next 4 years, we are coming at a higher valuation and higher base.
And thereby, I guess, you're wary of the momentum pack. But when it comes to momentum, Nilesh, that also includes PSUs all through and through across the umbrella. So you're saying go easy, maybe take some chips off the table there? Or just hunker down your expectations?
Within PSUs, one, absolutely hunker down your expectations. They were very, very cheap. Now they are fairly valued too expensive. There are certain PSU counters where floating stock is very, very limited. They are 3%, 4%, 10%, 15%. With such limited floating stock, price discovery in market is not efficient. It gets influenced by concentrated holding. It gets influenced by limited activity. I doubt if those companies want to raise capital in market, they will be able to realize today's market value. They'll have to offer substantial discount at current market prices to raise capital. So those are the counters which are avoidable. Today, there is limited floating stock. Some amount of buying can also pull the prices up. But I don't think so those companies will be able to deliver results which is demanded by current valuations. There are many hosts of PSUs which are fairly valued, which have attractive growth opportunity. In many cases, PSUs are oligopoly or duopoly structure. Might as well concentrate over there than in the momentum-driven low floating stock PSU counters.
Be willing to share some of those names for our viewers, Nilesh?
Let viewers also do some work.
Okay, keeping them guessing. But what about the outlook when it comes to the broader markets, just in terms of a trend as a whole, given that we are in an environment where the FIIs are selling, it is election year, we have seen that volatility. What's the rest of the year holding in store for mid and small caps vis-a-vis the large caps?
So one, we do believe that the valuations of mid and small cap is slightly above historical average valuations, whereas large caps are near historical valuations. One thing which we have to remember in the indices, by and large, low PE stocks have moved out of indices. Either they are PSUs or they are B2B companies. And high PE stocks have come into the indices. Either they are non-PSUs or they are B2C companies. This has resulted into current valuation of indices going little above, let's say, historical level of indices. And that's why we feel Nifty is trading at a premium to its historical average. Making adjustments for low P versus high P, I think Nifty is trading around its fair value. The small and mid cap and micro caps are trading little to way above their historical averages. Keeping that valuation perspective, we think on a risk-adjusted basis, you should be overweight large cap, underweight micro caps, and be selective in small and mid cap space. Going forward, events will determine market. Geopolitical risk and US Fed's pivot will impact FPI flows. FPIs are also struggling with dilemma. Should they buy Indian market, which is expensive but has a lot of potential? Or should they do bottom fishing in cheaper markets like China, Brazil, South Africa, and so on and so forth? If we can work with MSCI kind of agencies who create benchmark indices for global investors and push for the upgrade of South Korea from emerging market to developed market, as South Korea now is a developed market, and also get some of our stocks like HDFC Bank included at 100% weight rather than 50% weight, this could result into India's emerging market weight going up from about 2%. That could push passive funds to bring money. That will also push active funds to reduce their under-allocation or underweight to India. So we can influence FPI behavior by proactive steps like we have taken in the past.
Nilesh bhai, always a pleasure. Thank you very much for joining us. Private banks, FMCG and IT, some contra ideas where the market expectations are so low and so limited that you always will find bargains when there is near-term concern for next 3 or 4 quarters.
If you like this video, then like, share and subscribe to ET Now.